Good morning. I want to welcome you to the weekly recap for the liquidity source. And today we have three topics that we want to discuss and drill down a little bit so you get a better understanding of what it's all about. Debt yield. So debt yield is really net operating income over the size of the loan. It's become more and more effective recently as banks look for other calculations to make their job of making things less risk adverse for the bank. The interesting thing about debt yield is that it's static. By this, what I mean is that the amount never changes. If you, for example, had a property that was throwing off $1 million a year in income, and you had a loan of $10 million, you have a 10% debt yield. It wouldn't matter if it was a 30-year amortization, it wouldn't matter if it was a 20-year amortization, it wouldn't matter if the interest rate was high or the interest rate was low. There's no way to manipulate that. It's strictly net operating income over the size of the loan. And why is that important? Because for certain banks, they may want to know that there's sufficient cash. So if it's 10%, that basically means that after you've paid the loan, there's 10 cents on the dollar left, always. Doesn't change. That's completely different when you get involved into things like debt service coverage ratios and other calculations, because interest rates change. In certain environments, you have high interest rates or low interest rates, so that would change your debt service coverage. And also, when you go from 20-year to 30-year, it changes the debt service coverage. So all these things change, but the one thing that you can count on is debt yield. That never changes, and it gives the bank a chance to see that spread and how much money you're going to be making on every dollar that's been invested by the bank or the loan. Very important. In debt yield, there's an important concept here. Many banks, especially the large banks, will only give 20-year amortizations on mortgages. A lot of banks will go up to 30 years. Some banks are very aggressive on interest rates, and some banks are not. All that being said is the differential or the manipulation in time frame changes the debt service coverage ratio, which is a huge ratio for banks, and we'll talk about that more. But for right now, just understand that a 20-year yield versus a 30-year yield, or a high interest rate versus a low interest rate, completely changes your debt service coverage ratio. So that can be manipulated, while the debt yield can never be manipulated because it's net operating income over a loan, period, the end. It doesn't matter what the amortization period is, it doesn't matter what the interest rates are, it doesn't matter. It's basically telling you, I gave this guy a loan of $1 million and he's making $100,000 a year, he's making 10 cents on the dollar, period, the end. That's important. Debt service coverage ratio, also known as DSCR in the banking industry, and to, of course, their clientele. We've talked about this before, but I think it's something that really needs to be focused on more because it's really important at the banking level. Basically, it's a coverage ratio. The bank wants to make sure that at all times there's a sufficient amount of cash coming in that they're not going to have a problem with the loan. Some banks will be less aggressive, maybe 1.20, and some banks will be more aggressive, maybe 1.35. But on top of that, add in the fact that if you have a tighter amortization schedule, so let's just talk about that for a minute. If you have a 1.35 debt service coverage ratio, and then on top of it, it's only 20 years, you're getting a much lower loan amount. If you have a debt service coverage ratio that's 1.20, and you can get 30 years amortization, well, you're going to get a much higher loan amount. So depending on what your needs are as far as size of the loan, you may be going after, and that's where we could help, because depending on what the needs of the client is, because I think what's really important for the client is they get a customized solution for their needs. If you're sitting with a lot of cash, it's not so important. You may go to a bank that has 20 years just because it's more aggressive and you want to pay off the loan faster. But if cash and loan needs are really important, then the right person needs to take you to the bank where there's 30-year and they're not as aggressive on debt service coverage ratio. So in debt service coverage ratio, basically it's the net operating income over the annual debt service. That's really the formula. That's really the formula. So let's go back to the facts of debt service coverage ratio. It starts again with gross income. So the bank wants to see all your tenancy and long-term leases and how much income you're getting. Also could be from parking or other things in the building. Also could be from commercial real estate in the building, mixed use. And once they get that, then they're going to take a 5 to 10% vacancy charge against that gross income, again for coverage. And then they're going to take and go through a transparency check on all your expenses to make sure the expenses are in line. And when they're done with that, you will get what they call a net operating income. When that's presented to the bank and checked, the bank's going to decide at that point, how much can we loan this person? Or what kind of loan are they looking for? This will be predicated on debt service coverage ratio. And it'll also have the elements in it of amortization, whether it's 20 years, 25 years, or 30 years, and also interest rate. So what basically happens, if the interest rates go up, the loan amount's going to go down. And if the amortization period is tight, the debt service also will be affected. All these things will affect your loan. So depending on what your needs are, when one is looking for a loan, and you have customized needs, because everybody has customized needs. Maybe it's just the fact that when you bought the building, you only need to stay there for 5 years. Instead of 10 years or maybe generational wealth. Why is that important? Because the shorter the term, the less the interest rate's going to be. So again, all these elements affect which bank you should be working with to give you the best deal, the best rate, the best terms, and of course the most aggressive debt service coverage ratio to give you the amount of the loan that you're looking for. So you may, if any of this resonates with you, you may want to reach out to someone like the Liquidity Source. We can help you through this entire process. Cash flow. Okay, cash flow is very important for all investors. So basically, the basic thought process is you're buying a property, you're going to get a certain amount of income. It's called gross income. Typically, it's like in multifamily, it's all the rents. You may have a mixed-use space, it would include the commercial. You may have some parking spots that would also be included. The total gross income. And then you're going to discuss or find out exactly what the expenses are on that property. When you take the gross income and you minus the expenses, you have what they call net operating income. So what's after that? You've gone to the bank, you've gotten a loan, and that's your debt service. When you take your net operating income and subtract your debt service, it's known as cash flow. So you get a basic sense of what cash flow is on the property.
And how does is it a global cash flow or is it just called cash flow?
No, it's called cash flow. Global cash flow is really all your properties.
Gotcha.
That's really have to be transparent.
So how can cash flow, how does your cash flow affect how the banks perceive your project?
Well, first of all, it's very important. That's a good question, because when the banks look at your net operating income, they also include, and these are a couple suggestions, vacancy. So to make sure it's a little more conservative, if it's multifamily, they may add 5% of your gross income, take that off to cover for vacancy that you may have to redo a lease during the time frame. Also, they look at the expenses and they want to make sure that the bottom line makes sense for the bank to give you an amount of loan that you're requesting. It all has to fall in line. So that's all. The cash flow is very important. So when you work on cash flow, it's very important to include the things like 5% vacancy. If it's commercial, it may be up to 10% vacancy. This is very important, because you want to have a conservative approach to your bottom line, and so do the banks. And also, I would make sure that you include potential maintenance, it could be CapEx, things that you may need. You want to make sure those are in your figures, because at the end of the day, you want to make sure that your bottom line is truly your bottom line, and you don't want to be fooled at the end that you didn't make anywhere close to what you thought was. So it's good to take a conservative approach and include the items that all banks would include as well, to make sure that your bottom line is in fact your bottom line.
Does the liquidity source help clients with that process, like getting your cash flow outline? How do you help your clients with cash flow?
That's a good question as well. I think that it's important, first of all, when you get the information when you're purchasing the project, to review all the items and the expenses, because like I've said in prior meetings, the real estate taxes that they may have given you may in fact be higher. They quoted you a real estate tax that was maybe from 2 years ago. By looking at the financials or the tax returns, you may find out that the maintenance was running very high. They had a lot of work to do, and that wasn't included in your estimates. So there is definitely a discovery process, and at the bottom line, you want to get as much transparency as possible to make sure that the property that you're looking at is in fact the right investment for you. Another element that we would help with is to do a 5 or 10 year projection on the property, because the great news about sound financial investment is that rents increase every year, hopefully 2 or 3%. So you can find out over the 5 or 10 year period not only how much additional cash flow you'll have at the end, but even more significantly, what is that property going to be worth in 5 or 10 years after the elevation of all the income. So we help put those things together, and you can see where your property will be at that point, and also how much you've paid down on debt. So all in all, it could be a win-win. Less debt, more income, higher appreciation. Some properties are very, very tight on the loan to value. So by loan to value, I mean the amount of money the banks can give you based on what the property is actually worth. And it can be very tight. And so could be the expenses and the debt service coverage. So at the end of the day, banks sometimes will fixate on this debt yield, because if it drops below 8% or maybe 7% or 6%, they may reduce the loan. In other words, to satisfy the debt yield. So you can get the loan on the same property. This has happened before to me. They're going to get that loan, but they were asking for $5 million, and maybe because the debt yield was lower than 8 or 7%, they just lowered the amount of the loan to make sure there was enough satisfaction with the bank that a certain amount per dollar was being earned in that time frame. When we're involved in a process to help our client as far as preparing for the proper cash flow, the transparency is very, very concerning. We go through the expense reports and make sure that the maintenance, the real estate taxes, all the items that are included are checked in prior financials and tax returns to make certain that your bottom line is truly your bottom line. So you want to make sure that's all done, and you need an expert at times to help you through this process. Follow us for more information on commercial real estate. Like, follow, subscribe. Leave any questions you have in the comment section.